Hello, I'm Jerry Romine and welcome to my channel. Today I'm going to be teaching you how to sell a put option with detailed examples, and I'm going to walk you through how to place the order. Put options are also known as naked puts or short puts, and they are all the same thing. This is both a bullish and income strategy, and I will show you how to do both strategies. This is the 5th video in my option series, and these are what I call option basics. And if you are brand new to options, you'll want to watch my other option videos or pause this video right now to brush up on the basics. And I do want to introduce you to implied volatility, which is a measurement of how much a security will move up or down in a specific period of time. High volatility means we have higher premiums, which is a great time to sell options, and low implied volatility means we've got lower premiums, which is a good time to buy options. Next, we've got the option Greeks, which are a set of mathematical calculations designed to help investors assess risk. The Greeks allow for the measurement of the impact that changes in various factors, such as time and volatility, have on an options contract. Pause this video if you need to review the Greeks. What is selling a put option? It's a bullish strategy where you sell a put, making you liable to buy 100 shares of the underlying stock at the price if assigned. The goal is to either profit by collecting the option premium from an expected short-term neutral to bullish price action in the stock, or to acquire the stock at a lower price if assigned. If the auction expires above the strike price, we get to keep the full credit. Now, I normally like to sell a put that is at the money or out of the money. Our maximum profit, the potential profit, is limited to the net premium received, and our maximum risk, it is substantial because the stock price can fall to zero, although that's extremely unlikely. Let's go over some of my selling a put criteria. Number 1, you must or you should have the cash ready to buy. Number 2, the time frame varies. The further out you sell, the higher the risk and the higher the put premium. When do we want to sell? I like to sell when implied volatility is high to collect higher premiums. Think of too much, too fast, because that is money, and I'll show you that on the charts in just a minute. Which price to sell? The closer to at the money, the more likely you are to be assigned. Choose the strike price you want to buy the stock at, or go deeper out of the money if your goal is for the option premium income. Number 5, a negative 0.4 delta means there is a 60% chance the put option expires worthless at that moment in time, and you will keep the entire premium. So we just want to look at the delta to know what our odds are. And number 6, only do this strategy if you are happy to buy the stock at the put price you sell. We learn best by doing, so let's walk through a detailed example, and we'll start with a sample Discord trade alert, which gives us all of the information for selling a put option. In today's example, we are going to look at a company that has been on fire and has a very high implied volatility. Most people would see this stock as having moved up too much too fast, and this is the perfect setup for this strategy if you like that stock. Our first example is we want to sell a put and we want to buy the stock. So this is risky. That's because all options are risky, and we're going to sell the IPI, which is Intrepid Potash put, and this is also known as a naked put. And I want to restate, we want to buy the stock with this example. Our expiration date is going to be May 20th of 2022. Our strike price, we're going to sell the out of the money $85 put at $5.90, and that's $590 because one option contract is for 100 shares, and I'm going to show you this on the charts in just a minute. Our break-even price is going to be $79.10, and that's going to be a 23% discount from the current price. Our maximum profit will be $590, and our maximum loss would be if the stock went down to zero, which is a very small likelihood. And then our reasons, I always like to state the reasons I'm doing a trade, and we want to buy the stock at the break-even price, which would be $79.10. We are bullish on the stock, and it's a bonus if the implied volatility is high and there is a chance of us being assigned. And then we restate what our strategy is, and I like to sell a put that is at the money or out of the money to achieve that break-even price right here that we want. In our second example, we are after the income, and our big change here is we are going to sell the out of the money $55 put and take a look at our break-even price. It is now $54.10, and that's going to be a 47% discount from the current price. And our reasons, we want the income, we are bullish, there is a low chance of being assigned, and it's also a plus if the implied volatility is high because we get a higher premium. And then on our strategy for income, I normally like to sell an out of the money put with a negative 0.05 to negative 0.07 delta, and I'll show you that on the charts in just a second. Now let's jump into the Thinkorswim trading platform and I'll show you step by step how easy it is to sell a put. And if you use another trading platform, the process will be similar. We're now in Thinkorswim and we're looking at Intrepid Potash, and this is a fertilizer stock and the ticker is IPI. And if we look at the chart, we really like to buy whenever the stock is close to the 20-day moving average, but we can see they've gone up what we call too much too fast. So what do we do in a case like this? This can be a great time to sell a put. And one of the things we're looking for is high implied volatility. And if you look down at my momentum dream indicator, I've added it right down here, and we can see the implied volatility is 119%, which is really high. And for options, if the implied volatility is low, we like to buy. If it's high, we like to sell. So now we know we want to sell this put. So let's jump over into the options. And to jump over into the options, we're going to come up here and we're going to click on the trade button. We're now in our option menu, and the first thing we need to do is figure out which option that we want to buy. So we're going to look at the option chain. We want to buy one that is about 1 month out, so that would be the May 20th. And then on the left hand side we've got calls, on the right hand side we have puts, and the one we're interested in is going to be the $85 strike price. And we can see right now the bid on it is $4.70, the ask on it is $7.10. This is a really big spread. So the first thing we're going to do is we're going to click on the sell button, and that pops our order up down below, but we don't want to receive $470 for it. We want to get more closer to that ask price. So what we're going to do is we're going to change this and we're going to split the difference, and we'll go up to $5.90 on it, and now that's going to give us a much better price. We click confirm and send, and now we're looking at our order confirmation dialog box, our order description right here on the top. Our break-even stock price is $79.10. Our maximum profit is $590 that we receive. Our maximum loss, this would be if the stock dropped all the way down to zero, not likely. And then we've got the rest of the stats right here. But what we're after is our break-even stock price, $79.10. And if we want to buy it for that price, then we would want to sell this put. And now let's go over the example if we wanted to go for the income. So now the only change we're going to make is we're going to go further out of the money. So we want to go to a lower strike price, and that would be the $55 price. And we know that we want that because we're going to look at the delta, which is right here, and we wanted it around negative 0.05. That brings us here to the $55 strike price. Now we're going to click on the sell button, and then you notice we've got a really big spread between these two. So let's split the baby here, and in that case we're going to be going at 0.9. All we do now is come down and hit confirm and send, and then we've got our order confirmation dialog box. We've got the sell order, everything is repeated. Our break-even stock price is $54.10. Our maximum profit is $90, and it covers our maximum loss, and that's how you sell a put. Is this strategy worth it for the income? Well, let's assume you do this every month for 1 year. Our weekly profit on the income strategy would be $90. Our annual profit would be $1,080. Our capital would be $5,410 that we use for each trade, and that's based on today's put example. And then our ROI would be 20%, and here's the math for it. And I've got a disclaimer. This is a rough estimate. Obviously, the prices will vary every week, but an approximate 20% return for a strategy with a 95% success rate on a stock you like is pretty good. And that's how you sell a put. It's really an easy strategy and one of my favorites. I love selling puts when a stock has gone up too much too fast because we either get to keep the option premium or we get the stock at the price we want. I made this video so you could understand the strategy and know every step of the process. If you got anything out of today's video, please give it a big thumbs up and let me know what you think in the comments. And this video is part of an option series I'm creating, so be sure to subscribe so you don't miss the next video. Thank you so much for watching. My name again is Jerry Romine, and I'm an active investor, plus I have a Discord where I provide stock and option trading alerts, and that link below is if you'd like to check it out. Thanks again, and I hope to see you on the next video. Peace.